Ladies and gentlemen, good day and welcome to Aarti Drugs Limited Q3FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adesh Patil, Chief Financial Officer at Aarti Drugs Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us today to discuss our financial results for the quarter ended December 31st, 2021. At the onset, I hope everyone is healthy, safe, and taking all the necessary precautions in the wake of the third wave of COVID-19. Before I take you through the performance highlights, allow me to remind you that as communicated in the earlier earnings call, the financial performance on a year-on-year basis is not exactly comparable, especially in the terms of realizations and margins because of elevated API prices driven by sudden supply disruptions due to COVID-19 related lockdowns during last year. The company posted robust growth in revenue and profitability along with considerable improvement in the margins on a sequential basis. The robust performance was delivered in spite of the high freight cost, elevated coal prices, and sustained high raw material prices. I will now take you through segment-wise performance. First, we'll discuss standalone business performance. The standalone company has contributed around 579.9 crores to the total consolidated revenues in Q3 FY22. This contributed approximately 91% to the consolidated revenue. Around 59% of these revenues came from the domestic market and 41% from the export market. I will like to point out that we will be putting up some corrections in our press release as follows. There was some mistake. So our domestic revenue for the standalone business grew by approximately 10% on year-on-year basis for the current quarter, and exports grew sharply by around 54.4% year-on-year basis. We expect the trend in export to sustain for few quarters considering the current inquiry generation pace of export markets. Similarly, domestic business is at the cusp of witnessing a recovery. API volumes grew by around 12% year-on-year, led by secular growth in across acute as well as the chronic therapies. For Q3 FY22, within the API segment, the antibiotic therapeutic category contributed around 46%, anti-protozoal around 16%, anti-inflammatory around 10%, anti-diabetic around 14%, antifungal around 10%, and rest contributed around 5%. Now we'll discuss formulation segment performance. For the quarter, revenue for formulation stood at rupees 54.9 crores. Approximately 30% of the revenue came from exports during the quarter. The company is well on track to increase export share for this segment, primarily driven by growing penetration in Latin America and selective African markets, new registrations in export markets, and government tenders. The company is strategically utilizing the foreign subsidiaries to tap these opportunities. Now we'll discuss about the specialty chemicals and intermediate segment performance. For the quarter, revenue for specialty chemicals and intermediates stood at rupees 66.6 crores, which grew 62% quarter-on-quarter basis and 74% year-on-year basis. We firmly believe that this segment is at the inflection point and a unique value proposition. Niche product profile and upcoming capacities in chlorosulfonation products are expected to bolster the growth momentum further. On a consolidated basis for quarter 3 FY22, revenue stood at rupees 641.5 crores. EBITDA stood at rupees 96.7 crores and PAT at rupees 58.3 crores. EBITDA margin percentage came in at about 15.1% at consolidated basis. The company posted robust growth in revenue and profitability along with considerable improvement in the margins on a sequential basis, as mentioned earlier. This robust performance has come amid multiple headwinds in terms of high raw material prices, high freight costs, and high coal prices. The margin expansion is primarily driven by proactive price hikes, API volume growth across therapies, and strict cost control. The volume growth is expected to accelerate further on the back of recently commissioned anti-diabetic capacity, also upcoming antibiotic chlorosulfonation capacities in near future will give impetus to volume growth in next financial year. This, coupled with a growing share of niche products in chronic therapies and a strong API product launch pipeline, is expected to augment the margin profile and profitability. For 9 months FY22, revenues from operations stood at rupees 1,802.7 crores as against 1,656.6 crores last year, up by 8.8% year-on-year basis. EBITDA stood at rupees 251.8 crores. EBITDA margin came in at 14% and PAT stood at 149.7 crores. The investing cash flow for 9 months FY22 stood at rupees 103 crores and is expected to be in the range of 150 to 200 crores for the entire FY22, which will be funded through a mix of internal accruals and debt. The pace of capex was impacted to some extent due to incessant rains in Maharashtra and Gujarat during first half of FY22. However, the capex of Maharashtra projects has picked up a good pace and Gujarat projects will follow the suit. The balance sheet continues to remain strong with a comfortable net debt to equity ratio of 0.51x as of December 31st, 2021. We can now begin the Q&A session and we'll welcome questions from the participants.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Abdul Kedar Puranwala from Elara Capital. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. So, first question is on margins. So, earlier we have been talking about achieving close to 18% margin. So, sir, by by when that would be possible, or are we first of all reiterating that guidance ahead as well? Am I audible?
Yes, you are audible. However, it seems we have lost the line from Mr. Adesh Patil. We request all participants to stay connected while we reconnect him. Ladies and gentlemen, we request all of you to please stay connected. We are trying to reach to Mr. Patil. Please be on the line. Thank you. Ladies and gentlemen, we have the line for Mr. Patil connected. Mr. Puranwala, request you to please repeat your question once. Thank you.
Yeah, sure. Sure. So, hi, sir. My question was basically on the margin front. So this quarter, we did see some improvement on an EBITDA front. But, I wanted to understand that, are we still holding our long-term EBITDA margin guidance of close to 18%? Or, by when should we actually see this start reflecting into our reported numbers as well?
I'm sorry, it seems we have lost the line from Mr. Patil once again. Ladies and gentlemen, please stay connected while we reconnect him. Ladies and gentlemen, thank you for patiently waiting. We have the line from Mr. Patil connected. So over to you. Please go ahead.
Yeah. Hi, Abdul. I heard your question. The thing is, the recent drop in margins was mainly because of gross margins was mainly because of rising raw material prices. Now we have taken the price hike at the output side. The selling prices have gone up, and now we are seeing a trend of reversal, which will take time though. But we have seen the negotiated prices in the month of December for raw materials, they are coming off. They are tapering off. So we do feel that the gross margins will improve in future. And also, as far as the EBITDA margins are concerned, the coal has been a major factor. Means we lost almost 5 to 6 crores of EBITDA per quarter just because of the rate variance in the coal, which seems to be of temporary nature and should revert back. So, in the long-term basis, yes, we do aim for that 18% margin of EBITDA.
Understood. Sure, sir. Well understood. Now my next question is basically on this chlorosulfonation opportunity what you highlighted. So, going ahead, how should we look at the specialty chemical as a division, and in terms of the what could be the contribution of this business, say, in the next 3 to 4 years?
Yes. So the thing is, we are adding up capacities in specialty chemicals. In fact, one of the chlorosulfonation lines will be active in the this current month itself, in February 2022. So we expect the specialty chemical, the potential means the capacity potential to almost double from what we are right now with this current capacity addition. And we also plan for greenfield capex, which is yet to start for specialty chemicals. That should, that will be another leap forward in terms of increasing the contributions, the pie of specialty chemicals segment to our overall consolidated revenues. But right now, in short term, in near future, like in next 2 years' time, we can see that we can double the revenues from specialty chemicals from where we are right now.
Sure, sir. So in just to follow up on this, so the spec chem revenue, when we're talking about doubling, does that include what we're doing under the PLI as well?
No, these are the regular products. I'm talking on overall basis.
Okay. And I heard on the opening remarks you mentioned about some delay which had happened on Maharashtra because of the ongoing pandemic. So, sir, but how should we look at our overall capex trend? I mean, has the timeline now revised by almost 6 months? What are we going to complete, say, by end of next year?
Yeah. So the thing is, right now we are doing big greenfield expansion at 2 locations, one in Maharashtra and Gujarat. So the Maharashtra capacity ideally should come up by December 2022. It should be commissioned and ready. Whereas the Gujarat facility should come up by February, March 2023. around that. So approximately in 12 months' time, we still expect both these capacities to become operational.
Okay, so not much of a delay. And just one final question on the formulation business. So this we are seeing from the last couple of quarters that formulation business is not picking the pace as kind of what we expected. So sir, going ahead, as you mentioned, one would be the Africa segment, but what could be the other driver of this business? Within the existing geographies, what you're currently catering to?
Yeah, I think Vishwa can handle the question better.
Yeah. So,
Sorry, Vishwa, your voice is breaking, sir. Mr. Savla, please go ahead.
Yeah, I can hear you. Yeah. So that the
Mr. Savla, your voice is breaking. I request you to please.
Can you hear me now?
Yeah, this is better. Please go ahead.
Yeah. So growth from the existing geographies in the next for the next couple of years, where we've established ourselves majorly in Latin America and Africa. We have now our distribution in place, and we are adding more and more products. A lot of our products are under approvals, and we are receiving approvals. And we are also participating in institutional tenders that will give us a higher growth push. So for the next 2 years, we will continue having growth from our existing territories, and at the same time, we are working heavily on to development of products for regulated markets in Europe and North America, and those markets will start picking up for us in about 2 to 3 years. So for long-term growth, we are anticipating from regulated markets, whereas short-term for the next 2 years, we have good growth plans from our existing markets.
Awesome, well understood. Thank you for answering my questions, and wish you all the best.
Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Cinderella Carvalho from Centrum Broking Limited. Please go ahead.
Yeah, thanks for the opportunity. And Adish, if you can help us understand, if I look at, you mentioned in your commentary also that there is some supply side pressure on the input cost is reducing or easing off. But in terms of our earnings reflection, when do you see that will reflect meaningfully? And if the pricing or cost levels are coming off or easing off, would that mean that our final price also would get adjusted to it? And by when do you see all these things? Even there will be a gap, we understand, in terms of, seeing the current prices in our earnings. So can you help us understand the current scenario where we are and how it should proceed over coming 2 to 3 quarters?
Yes. Thank you for the question. I will answer this question by giving few details. Like after we order local material, typically within 1 month's time it is delivered to the factory. After we order or import, we give import purchase orders, then within 2 to 3 months time they get delivered to a factory. Now the trend what we have observed is that on a monthly basis, if I analyze our the purchases which we received at factory in the last quarter, still we saw that more than 60% of the raw materials, 60-70% of the raw materials had the maximum rate in the month of December when that material came into our factory. So that will definitely affect the margins of the month of January and February. But because we have taken price hike, that will insulate us to some degree, no doubt about that. And as far as the purchase orders are concerned, the negotiated purchase order rates, what we have observed is that only 17% of the raw materials, 17, had maximum purchase negotiated rates in the month of December, and rates more than 80% of the raw materials, the rates have fallen down in the month of December. So that will definitely show up towards the end of this Q4 and in the beginning of that is the first quarter of next financial year.
So basically, starting next year, we should see normalization. But would that mean that our end prices also will adjust accordingly if the raw material comes down? You see some impact on pricing?
To some extent, we will see, no doubt about that. But the main challenge what we had been facing in last year was the sudden changes, variations in the price. Whenever the prices settle down for say 3 months or so, I'm talking about the raw material prices, then we can easily reach that 17-18% EBITDA margins based on the volumes which we are manufacturing. But then any movement, in the prices, usually that kind of shocks, it is difficult to exactly correlate the selling prices with the input prices.
Understandable. Helpful. On the demand side, we are seeing some good traction, which is very positive scenario. But I understand that most of it would be driven even by the price hikes that we are taking. So how is the outlook on the demand scenario? And if you can help us understand on the specialty and the API side, both put together. And if you can help us understand the formulation run rate that we should look at from an annual basis, that will be helpful. Over to you.
Okay. As far as the specialty is concerned, right now our capacities are very small, as compared to the global demand. So it will be relatively easy to capture the market. It won't be that difficult. And our new processes, our cost will also be much lower than our existing cost of production for the same product in chlorosulfonation. So definitely, specialty chemicals we should be able to sell quickly. As far as the APIs are concerned, can you repeat the question related to the API?
API also, I'm asking you on the demand side. We are seeing some strong traction, but however, it has accompanied by the price increases also. So how should we see this?
As far as the exports are concerned, we have a lot of demand because we already have a lot of pending orders in hand. And domestic sales domestic API demand usually picks up in the fourth quarter of every financial year, because that is the time when most of the formulation company increases their production volumes. So now in Q4, ideally the demand should be more for APIs in domestic. And for formulation from 2 to 3 years perspective, I will request Ishwar to answer your question.
Yes. So in formulations as well, we are expecting good growth, mainly due to some capacity enhancements in our existing facilities, as well as product line extension in terms of getting new products with better margins. And our new greenfield project into oral oncology is also upcoming, which we are expecting to commission by the end of quarter 2. So that will also, over the next 3 to 4 years, give us a good revenue growth and with improved EBITDA levels.
So what should be your annual run rate? I mean, we have seen some decline in the one edge. How should we see it overcoming 2 to 3 years? Any range that you can help us understand? Because if you're talking about oncology also, how big it is, what is the basket of product, how much can it contribute? Would from a 12% share, can it become 15-16% or 18-20%? What range are we looking at? If you can just help us with some numbers, some broad range would be really helpful.
Sure. So over the next 3 years, we are looking at a growth rate of about 25% annually. And oncology would, so we have about 10 to 12 products lined up in the oral oncology sector, which we would be filing in international, global regulated markets. However, since we are targeting products with patent expiries starting from 2024 to 2027, so oncology as a sector for us segment for us would start contributing post FY24 majorly.
आपण ज्या व्यक्तीसोबत बोलत आहात
Yeah, but even our general segment would give us growth of about 25% annually.
Okay, thank you, Vishwa. I have more questions. I'll join back the queue.
Sure.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. Our next question is from the line of Riya Verma from Oracle. Please go ahead.
Hi, sir. Thank you for this opportunity. My first question is, formulation segment witnessed a decent amount of fall in revenue. So can you throw some light on that? And when can we see a pickup in revenue again?
Yeah, so I'll answer that. So the revenue fall in formulations in Pinnacle was a temporary blip in this particular quarter due to lower demand, especially in the domestic segment. However, we are seeing in the current quarter, in Q4 itself, we will see a good recovery. And going forward in the next financial year, we will expect, like I said, a growth of about 25%. So I'll say the drop in revenue was temporary, and we are already seeing a recovery in that.
Okay, sir. Secondly, you mentioned about a strong pipeline for product launches. Can you give us some guidance on what are the products we are planning to launch in API formulation as well as specialty chemical segment?
Yeah, so I'll answer for formulation, and probably Arish can answer for this API and specialty chemicals. So in formulations, we are currently having a pipeline of 8 products, which are majority of which are with backward integration of the API, and we majorly are into cardiac and diabetic products, new age products. So products which would be going off patent from the next financial year. So we will be targeting day one launches in majority of our markets. And apart from that, in oncology segment, we have a pipeline of about 10 products, which are majorly tablets and capsules, new age oncology products, in especially the NIB category of products.
Okay, sir. And
yeah. And regarding the API, we are if I will tell you the main therapeutic areas where we are expanding in a big way. So anti-diabetic obviously is one of our favorite segments. There we are already launched a couple of gliptins in the current year. So they will in next couple of years their contribution should become meaningful. Then we are launching a derma product in the next financial year. Then we are expanding. We already expanded one, and one we are further expanding in antibiotic segment. In antifungal, we are launching a new product very soon, and also expanding the current one, which we already have. Then we are also doing brownfield expansion of one of our cardiovascular product, which is very popular. And then in specialty chemicals, as we discussed earlier in earlier con calls, that we are coming in a big way in chlorosulfonation. Then we are also doing backward integration of for few of the intermediates, which we may also sell outside. Means the derivatives of those intermediates we will sell outside. And we also have a contract manufacturing with MNC for one of the specialty or intermediate product, which we have expanded recently because they have increased the business volume with us, looking at our performance in last couple of years. So the growth is spread across a lot of products actually in coming future.
Okay, so that is helpful. And my last question is, what is the current status of our US FDA inspection for our facility,
Yes.
which is under imported?
Yeah. So we already paid the Usfd in this December quarter for USFD, and the thing is, we were in very close contact with ex-USFD inspector. So they have already started reviewing our all the responses and everything. Means we already had done all the work. All the background work is done. So the last step is this. Once this ex-USFD inspector reviews everything, they will come with a focus approach to audit our plant in person at the site, and then they will represent the case. Means they will represent the findings to the USFDA directly. Actually speaking, it was supposed to happen by now, December. It was supposed to happen, that visit, but because of this third wave, their travel plans got delayed. So that is why they took another approach of first doing the remote audit or remote review kind of a thing, and then come in and do the on-site thing quickly.
Okay, sir. Got it. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Thanks for taking my question, and congratulations for good result. So just I wanted a clarity on your earlier comment. So 17% you said the raw material cost was negotiated for a price. That's what you said?
Yes. No, I will explain again. So thing is, we did two different analysis. One was the material which came into the factory every month, and that material price was negotiated a couple of months before in the purchase order. And the one analysis what we did was regarding the new purchase orders which we have raised. That material will come in after 1 month or 2 months or 3 months. So what I was saying that the out of the total raw materials, for 17% of the raw materials, the negotiated prices in the month of December was still the highest amongst October, November, and December. But for rest of the more than 80% of the raw materials, the prices have tapered off. The negotiated prices have tapered off in the month of December.
Okay, and this is the tapering of a price is triggered due to a softening of prices there, or?
Yeah, mainly yes, because the sudden splurge was more of opportunistic kind of price hike by our vendors because of demand supply situation, and there was frantic buying also in the market because the surety of the supplies was not there in those months. So a lot of people have bought. Even we have ramped up our inventory quite a lot in the quarter of December, and that is one of the another reason why our RM inventory had gone up. So that will also be one of the focus area in the coming quarters to reduce our operating working capital cycle. But then that was the reason. Mainly it was frantic buying because of which the prices had gone up. So now with the clearer picture coming out in the market, the prices are softening a little bit.
Yeah, so I wanted to understand this dynamics. So in case after witnessing a hike in price and then again price has softened, in case again the price is high, or normal industry, runs in a way it was running last year. So yeah, again the raw material prices goes up. Then a negotiation of only that portion of raw material you will be able to do, or it is nothing to do with this. Again, the new negotiation will happen.
No. No new negotiations will happen. So this is done. Means you have placed the orders.
Okay. Yeah, thanks. And the another thing on oncology side, what kind of API we are planning to produce? So whether we will have high potency facility there, or what kind of API setting we are doing?
Oncology we are doing at the formulation side, it's not on the API.
Okay. 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 So this is on formulation side. Yeah. And the last one, in budget, some solvent customs duty has been reduced. So anyway, are we benefiting from it?
A little bit we will be, little bit. The quantum, very roughly speaking, around 30 to 50 crores, somewhere in that range of the raw materials where the duties has reduced. Per annum I'm talking about. Per annum.
Okay. Okay. Okay, that's it from my side. And all the best, sir. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Thanks for the opportunity.
Tushar, your line is unmuted. Please go ahead.
Yeah, am I audible?
Yes, you're audible now.
Sir, while you have explained nicely in terms of pricing and pricing factor, but just would like to understand this disruption in China. Is this fundamentally or structurally driving more volumes to Indian companies like yours?
See, definitely means right since 2018, a lot of events have happened in past that suddenly, which basically is giving us an indication that China is moving more towards greener technology, and they are focusing less and less on manufacturing of specialty chemicals or intermediates and so on. Definitely, they will continue to focus in the areas where they have natural resources, so that they will continue to do. But more or less, the trend what we have seen is they are focusing more towards greener technology. So definitely, all these events give indication to global buyers that they should be de-risking their supply if they're depending only on China, and that has started to happen. And so, in fact, in this COVID only, one of the very big top 3 molecules, one of the biggest MNC customer for that molecule we were able to crack, which was the business of which earlier was going to China. So we are seeing that trend, no doubt. So it means it will be helpful in long run.
Understood. Fair enough. And particularly for this gliptins, while you are seeing good orders for the gliptins front, but what's happening on the, let's say, the existing or let's say the other molecules in the diabetic portfolio, in your diabetic portfolio?
Yes. So the other molecules are growing really well. December was good, and so those have shown a promising signs lately in last quarter.
And additionally, gliptins is further over and above that. That's the way to understand.
Yes.
All right, sir. Interesting. All the best. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. Here's the next question from the line of Cinderella Carvalho from Centrum Broking. Please go ahead.
Yeah, thanks for the follow-up. So Adesh, coming to the API side, if I try and understand, you mentioned about gliptins. How about our forming plant capex? Where are we on that? And in terms of gliptin, what kind of market share we expect to acquire over 2 to 3 years? What is the plan there? And in terms of metformin capex, if you can update us, that will be helpful.
Yeah. So regarding gliptins, it's more like a stage-wise expansion for us. We already have set up a gliptin multi-purpose facility for both the products, but we have 4 production lines in that particular location. So our next stage was, once the gliptins grow for us, then we'll shift one of the gliptins in another line. So we'll have 2 dedicated lines, one for each of the gliptins. And then from there, maybe after 2-3 years, if it grows even further, then we have space to put up another block itself. So that will be a very major capacity. So when that happens, then definitely we will aim for more than 50% of the market share, that kind of capacity, which we do for typically top 10 of our products, what we have done. So that round of expansion for gliptins will come maybe in 3rd year or so. But right now also we are very much, the capacity is good enough to get a substantial share of gliptins. But gliptins is a very growing market, so it's very difficult to put a number that how much share we will capture. It's a growing market. One of them is domestic focus and other is export focus. As far as metformin is concerned, so we are going very strongly with our current capacity of 1100 metric tons per month. The utilization is going up rapidly. We also have European approval for that facility. We plan to do Usfd soon. And we already have, all the plans are ready. The civil work is yet to start, but it will be completed once the project starts, it will be completed within a year's time. The 3,000 tons per month capacity. Obviously, we'll be doing this in a phase-wise manner. First, it will be 2,000 tons, and then it will be 3,000 tons per month. And as far as the other brownfield expansions are concerned, this antibiotic expansion within next 4 months it will be done. Then your derma capacity will come online maybe by December 22. Then another intermediate capacities will come online maybe around February to March 23. That is the end of next financial year. And antifungal product also, there are few new launches of antifungal products also, which will take up in one of the existing facilities. And once it grows again, then we'll have a dedicated block for that. Then our cardiovascular product also, we are looking almost to double the capacity from where we are right now, because there also we are seeing good demand. So lot of expansions are happening, small ones also, and also the big ones, greenfield capex.
Any update on the PLI side? Where we are? Do you think there is some delay there?
PLI side means we opted for with the in the PLI there was a condition of spending around 78-80 crores of capex to get that PLI. But then we had change of process, and because of which we are able to put up the same facility in about 25 odd crores, 25-30 crores, So there was upfront saving of more than 50 crores. So we thought that rather than applying and getting PLI every year about 8 to 12 crores per annum, means it was better to save upfront. So we have already gone and set up the plant. Means whatever we had planned, around 3/4 of that capacity is already commissioned, and the rest 1/4 will also commission very soon. So basically what I'm trying to say, instead of going for PLI, we have expanded in the same product, but with much lesser capex, which more or less equals to the PLI which we'll be receiving in next 6 years.
Thanks, that's helpful. Wish you all the best, and
Thank you.
That's all from me.
Thank you. Next question is from the line of Bob from Falcon Investments. Please go ahead.
Hello. Could you explain why you continue to focus on formulations, given that you're subscale even in APIs? There's a lot of scope for APIs going forward. So what's the need to go into formulation?
Okay. So more from a strategic point of view, you're asking, right? Yeah. So the thing is that, as you said, that the basic strength of our company does lie in manufacturing bulk products where the volumes are very high. So we are doing that wherever possible, wherever we are getting opportunities, we are doing that. And specialty chemicals and intermediates is something very similar to what we already do, which much lesser regulatory framework, you can say. But the manufacturing skills which are required remains the same for chemicals and specialty chemicals and intermediates. So there also we are expanding. However, the only piece which was remaining for us for vertical integration was formulation. So we are integrated on the backward side, but on the forward side we were never integrated. So what we thought that there are few products, very few products, which it's very difficult if the number of formulation players are concentrated, then it becomes very difficult. But the APIs where the number of formulation players are fragmented, there are 8 to 10 formulation players, then it becomes very good business case to manufacture API only. But if it is concentrated in 2 to 3 buyers, then it might be little difficult to sell that particular API with good margin. So for this and for value addition purpose, we had introduced formulation as a strategy. 10 years back, many of the formulation players, they used to purchase our API and give it to a third-party manufacturer or formulation manufacturer in Baddi, that is in Himachal Pradesh, and get their tablets manufactured from them. So what we thought that rather than doing that, we can offer their tablets on our own. Means we can give them a combined pricing of API plus the formulation, and that was the main you can say starting point of our formulation business. And slowly we became experts. We had our own facility. Then we started registering in the export market because we saw there are few niche opportunities available with very high margins, and that is the reason why we started with the formulation division. It's a baby steps, and let us see where it takes us.
Thank you. Mr. Bob, is the question answered?
Yeah, I have another question.
Yes, please go ahead.
For how many APIs as percent of revenue are you fully backward integrated?
Yeah. So the top 10 APIs is contributing around 75. Top 15 would be somewhere in the range of mid-80s. And the thing is, in top 15, out of top 15, that in 13 of those molecules, we are largest manufacturer in India, and in few of them globally also. So I would say that the ones in which we are largest manufacturer, we have reached there because we are either same or more backward integrated than our competitors. So you can roughly assume that more than 80% of our revenues are backward integrated.
Completely back. So you don't import anything from China or elsewhere for 80% of your revenue?
No. See, the thing is, it's a very tricky phrase, saying completely backward integrated, because there are a lot of stages. Means we can go N-2, we can go N-4, N-7. But even for N-7, there might be some raw material which we might need from China. So that is always there. We can never get rid of that. But what we try to do is that we see how many manufacturers of that particular raw materials are there globally. Is there any risk of supplies for that particular raw material? If there is, and if there is good margins in that product as well, then that is the time when we take a call to go for further backward integration. And for many of the products which we are buying from China or elsewhere, we do have technology. We already have developed technologies as well. Means it is just that we are ready with the technology, but we don't want to put the plant yet because we don't want to over-invest. Because if you go further and further backward integration, then your return on assets will go down, because the sales turnover also will also go down to assets.
Yeah, I understand. So when you actually say you're backward integrated for 80% of your revenues, what do you really mean? What's your internal definition of backward?
What I really mean is it is all relating to the competition. That will be the good way of looking at it. Means as compared to your competition, how much you are backward integrated.
So what you're saying is even the top manufacturer for these APIs would only be as backward integrated as you are.
Yes, or less.
Is that what your point is?
Correct. Either as backward integrated or they will be less backward integrated than us.
Okay, so in terms of pricing, you wouldn't lose out because of the level of integration.
It gives more sustainability. Yeah. Correct.
Okay, understood. Okay, thank you very much.
Thank you.
Thank you. Anyone who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Surajit Pal from BOB Capital Markets. Please go ahead.
Hi, good morning. I have only one question. Is that about Gliptin? What percentage of the revenue coming from Gliptin? If you can quantify that.
Yeah. So as of now, we just launched, so it is negligible to our revenue. In couple of years, the contribution will become meaningful. So as of now, it is just like a launch. So in APIs, typically there is a just for local markets there is gestation period of almost a year, and for export markets it can take anywhere between 18 months to 36 months, depending upon what kind of markets you are supplying it to. In ROW market, it will be less, but in semi-regulated and regulated markets, it will be more.
My doubt is that because recently what we are hearing from the formulators in India, Gliptin is gradually and slowly losing the market share to the new generation of molecules. As they say that metformin has always been a gold standard. From metformin, the second line of treatment is basically Gliptin.
Correct.
And those Gliptin is losing market share to the dapagliflozin kind of new generation molecule. And Gliptin is mainly used as a one of those combination products in diabetic treatment. So in that case, if you go by the IPM data also, Gliptin is losing market share and losing the value. So I was just wondering is that how prudent it is to get into Gliptin and increase the capacity in that.
Yeah. So the thing is, the right now it's a good information for us, no doubt. So right now where we have put Gliptin is a multi-purpose facility. So we always have the option to if any problem happens for Gliptin, then we always have the option to convert that facility to something else. But as of now, Gliptin is still way ahead of the next generation molecules in terms of API sales, I would say. Not formulation, but the API sales. So still, it will take a lot of time for other molecules to catch up to Gliptin.
Okay. Thank you and all the best.
Thank you. Our next question is from the line of Gagan Thareja from ASK Investment Managers. Please go ahead.
Yeah, am I audible?
Yes, just a little low, but you're audible.
Yeah, good morning. So a couple of questions. One is, what's your dependence on China for your KSMs and intermediates by value?
So that would be little less than 20% of our raw material purchases.
Okay, and going into the future, you expect this to stabilize at these levels, or is there an intention to bring it down?
Right now, there is no business case to do so. There is one product though. I would name the product. There is one product where we are seeing a business case, and we are already working on that. But in the rest of the scenario, as of now, because the thing is, if the supplies are stable and there are more number of suppliers in China, then it doesn't make sense to put up capacity right now. But wherever we see there is a problem, there are only two players, something like that. If you see any risk of supply. Then we decide to go further backward integration.
But apart from China, you where else do you source your KSMs and intermediates?
Europe and Middle East.
Okay, so are they entirely outsourced, or do you also have some in-house KSMs and intermediates?
No, we do a lot of in-house. Means for a lot of products, we have like N-5, N-7 stages. So we do we manufacture a lot of products in-house. In fact, as I was talking earlier, that in more than 80% of the cases, we will be either more or as much backward integrated as our competitors. And that is the reason why our cost of production is low. Apart from volume, means economies of scale, the second most important factor is backward integration in this business. And that we have continuously done for our top 13 products.
Right. And just on the same topic, while I understand, you indicated that December on there's a softening in input prices. They are largely crude derivatives, as I understand, and given the current crude price scenario, do you see this softening sustaining, or do you feel that it's a small or a temporary dip, and thereafter the prices move back up again?
Is Harit Bhai available on the call?
No, the last year whatever raw material prices went up was nothing to do with crude. So it was mainly demand supply mismatch, and some of the plants were closed in US and China due to pollution and other things. So crude, of course, definitely will have some impact, but the price increase in last year in many of the commodity chemicals was not due to crude, but some other factor, demand supply mismatch. So which is now tapering off basically. Yeah.
Okay. So and this price increase, I mean, obviously, is a consequence of the input price materials going up. Right. I understand that one bit of it which you experienced is coming because of the disruptions in supply. But are these disruptions in supply, especially from China, of a temporary nature, or do you think that because of the policy or regulatory changes in China, some bit of the input cost increase is sticky and will stay because the cost of production itself would have gone up on a permanent basis?
Yeah, cost of producing chemicals and intermediates in China has definitely gone up, because many of their plants, they have to move to remote places from the cities where they were earlier. So definitely there was supply missing. This price will be definitely the issue now. Whatever, yeah.
Right, and but this should not benefit your margins as material prices soften, because it's just an absolute amount increment of inputs which you are passing on, right? And therefore, as that shifts or remains stable, as it stabilizes and the volatility goes out, your margins should remain in a stable band and not sort of move up is what I'm trying to understand.
Yeah, this.
Can you ask the question in more concise manner, because I was not able to pinpoint.
So my question is simply this: that if let's say your selling price was 100 for a particular API and your input price was 60, input price went up from 60 to 70. There's a difference of 10 which you pass on. So 100 goes to 110, input 60 goes to 70. So in absolute terms, you've passed on the 10 rupees, but in percentage terms, margins will actually come down, right?
Yeah, it's a very good question. The thing is, in short run, what you say is correct in short run, like month-to-month basis. But now, most of the companies, they are evaluated, even bankers also evaluate the company based on margin trend, typically. gross margins, everything. So so in short run, maybe people look at that, but on year-to-year basis, in longer run, people try to revert back to margins. Means then what you say means we will add one more rupee to retain the margins as well, something like that. But in shorter run may not be, but in longer run, yes.
Right. And you've got new capacities coming on stream throughout the next 12 months. What could be the OpEx related to that new capacity?
It's difficult for me to tell like that. Difficult. Means I don't have exact numbers that exactly how much OpEx will go up. But typically what we have seen that it means based on the historical numbers, historical trend, this thing has happened quite often in between. In last 10 years, it must have happened 3-4 times when big capacities have come up. What happens is our earlier capacities, they also keep on getting more and more utilized, So more or less it averages out. So there is not that big of impact.
So what you're saying is that as you sweat your existing assets more, it absorbs the impact of the additional cost and the margin remains stable.
Yes. Correct. Yeah.
And what's your utilization on your existing capacities?
Right now, for the last quarter, it was somewhere in early 70s.
Okay. So you have some more room to sweat them?
Yes.
You can take them
we continuously, as a part of our maintenance, what we call maintenance capex, but it is actually maintenance plus debottlenecking capex. So we continuously try to keep on increasing capacities in the existing plants as well. And we have successfully done it in last year for one of our antifungal products, one of our antibiotic products. And coming year, we are planning to do in one of our cardiovascular products as well. So we continuously do that, means the brownfield expansions as well. So that also helps us in having more margins in that plant, which subsidizes the cost of additional OpEx because of the newer capex, new plants.
Right. And in your presentation mentions 600 crore capex with sales potential of 1,200 over 5 to 6 years. What's the base or reference year over which you're saying adding these 5 to 6 years?
So the thing is, typically we were assuming full capacity utilization in 4 to 5 years once the capacity is online, and by next December 22. Or you can safely assume by the end of next financial year, most of this capacity will be online. Not all of it, but at least 70% of it will be online.
By December of 22.
December 22 or March 23. One by December 22, another by March 23.
And the presentation also indicates that there is room to improve margins. So what's the cost levers, or is it simply a sales mix related margin expansion? If you could sort of help us understand attribution on both the sides.
One is the backward integration program, the big greenfield capex which you are doing. One is the backward integration that will help us. Another is having more and more sales in the semi-regulated and regulated markets. We are consistently trying to take over, get more market share in those kind of markets where the selling prices are higher and the margins are higher. And another is what we are trying to do is something what we have already done in products like metronidazole, wherein now more than 95% of the India's production is our company's production, and rest is only China. So we want to achieve that level of market consolidation, because once that all happens, then the margins become much more stable. So something like that.
In which molecules do you see yourself getting that sort of a position?
So there are quite a few antibiotic products are there. One antifungal product is there. Then, in fact, one anti-inflammatory product is also there. So there are quite a few molecules which we have been manufacturing since last 15 years.
And when your LATAM sales goes up as it will over a period of time, it comes with its own set of issues in terms of currency volatility and probably higher working capital, if I understand that geography in some way. So in terms of currency risk, in terms of working capital, in terms of debt to equity, how are you thinking over the next 3 to 5 year time frame? Your thoughts there?
As far as currency risk is concerned, more than 95% of the business in exports we are doing in US dollars only. So that takes care of that. As far as working capital is concerned, you correctly pointed out that Latin America being the opposite side of the globe, it takes maximum time, transit time. So definitely the working capital employed required is more for those kind of sales, but then we accordingly charge. We build that cost into our selling prices. It is taken care of like that. And your last question was regarding the debt to equity ratio. Yeah. So debt to equity means whatever capex we are planning and whatever internal accruals we will be generating. And also we plan to do a shareholder payout of say around 25% of profit after tax. So considering capex and the shareholder payout both considered together, we still feel that our debt to equity ratio should not go at peak level beyond 0.7. That is what as of now we are envisaging.
Okay. So you'll take on more debt as you go. I mean, if you could just give us an idea of what's the capex plan.
We will take term loan debt, no doubt, for the greenfield capex to some extent, because the cost of debt is much cheaper than the cost of equity for us. And historically, means if you take out last 6-7 years, then before that, almost 30 years, we have run the company with debt to equity of around 1.5x, and there was absolutely no default in any of the years in working capital or nothing. So we were quite comfortable. But then we realized that we had the option of reducing the risk. So we brought down every year incrementally the debt to equity ratio kept on going down, and now it is at 0.51. So that is hence I said at the peak level we are envisaging around 0.7. But again, with more quarters as it will go by and the internal accruals which will add up, again the debt to equity ratio should come down.
What's the gross debt and where could it peak?
Around 500 roughly.
And at what sort of levels would it peak out? Absolute debt?
Absolute debt?
Yeah.
Absolute debt. Thing is, in this 500 also, around 330 or 336 crores is short-term debt only, working capital.
Okay.
And the long-term is less than 170.
But you will be adding to that, right?
Yeah. Now we'll be adding long-term debt more. But then there is a repayment schedule also. Almost 40 to 50 crores of repayments also happen every year.
Yeah.
In long term. So in absolute, we'll say point. We'll have to calculate that. So we take another 200 crores of long-term debt, and whatever working capital required for that also we take around 40 to 50% of that we fund through debt. The increase in the working capital. Okay. So typically, the way we will function is we will both put together, means term loan and working capital debt put together. We will make sure that the debt equity ratio doesn't go beyond 0.7. And when I say 0.7, I'm also considering shareholder payouts. In spite of doing that 25% shareholder payout, still we'll be at debt to equity of 0.7.
Okay, got it. Right. And finally, if you could just give me, what's the budgeted capex for FY23-24? You've given some idea of FY20.
As of now, the plans, whatever we have announced in the investor presentation also, those are the greenfield projects right now, which we have announced. And apart from that, say around 40 to 50 crores of capex we spend every year for enhancing GMP requirements or maintenance or debottlenecking of doing brownfield expansions in the existing plant. All that is covered in 40 to 50 crores per annum. So that plan will continue. And the bigger ones we will announce as and when we decide. Means that 550 crores of capex we have already announced. And maybe in a year's time we will announce further greenfield capex.
Okay. Thanks. That's all from my side. Thanks for answering the question.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Adhish Patil for closing comments. Thank you, and over to you, sir.
Okay. Thank you everyone for joining us on this call and giving more than 1 hour of your precious time. Please reach out to our IR consultant, strategic growth advisors, or us directly if you have any further queries. We can now close the call. Thank you and have a nice day.
Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Aarti Drugs Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.